So today's topic is the term structure of interest rates and yield curve. So term structure is very simply understood or very clearly a very clearly said notion. Term structure is nothing but we are seeing what is the term or we are holding the bond for what period, and we will see how the yield curve behaves, or whether it's a upward sloping curve or it's a downward sloping curve. We'll see like that. Okay, we'll see that with the help of some figures and try to understand what, like how, why this yield curve behave differently in different scenarios. Okay, now the term structure of interest rate describes the relationship between interest rate on bonds and the maturities of the bond as of a moment in time. As I said right now, the interest rates and the maturity periods. So the term structure describes the relationship between these two. The term structure of interest rates is a graph showing the rates for each different term of bond for bonds having the same risk characteristics. Usually, short-term bonds have lower yields because an investor has less risk with a shorter yield bond. Why? Because the money is, see, bonds are nothing but the borrowings from the people, what the companies do. Okay, they borrow from people. So if the borrowing is for a shorter period of time, there's less risk for the bond holders. Hence, they would derive less yield. Why? Because less risk, they would get less returns. Okay, see, yield is nothing but if you have a bond, you get coupon on that, then you reinvest, and then you get coupon on that, of interest on that also. So altogether, till the time you hold the bond, what is the total return you're getting is nothing but yield. Okay, that is nothing but the coupon plus the coupon reinvested. Now, for example, the graph showing the term structure of interest rates for US Treasury securities with different maturities. So US Treasury, see, it starts with 90 days, that is 3 months Treasury bills, then 6 months, then it goes on, then Treasury bonds is for 5 years, 10 years. Okay, so the term structure, you see, it's going on increasing. So if you take a 90-day T-bill, you get very less yield. If you get a 5 or 10 years bond, you get more yield. Why? Because there is higher risk. Now, the graph showing the term structure of interest rates for US Treasury securities with different maturities on one particular date will usually show higher rates for long-term securities than for short-term securities. Very easily understood fact. Why we have higher like rates or yield for long-term securities? We have, or we get higher rates or higher rate of interest or higher yields on long-term securities. Why? Because the term to maturity is for a longer period of time. It's a long-term bond, lot of risk. Your money is with the borrower for a long period of time. Default risk can happen for in a long period of time. Inflation can affect your returns for a long period of time. Hence, we cannot adjust with less rate. We want higher rates. Okay, for short duration bonds or for short term maturity bonds, you get less return or less yield. It's a understood fact. Now, when the rates and terms for various securities are graphed, the resulting line is called yield curve. Okay, so yield curve is nothing but this is a yield curve. You can see this is the term to maturity, and this is the rate what you are getting for each and every passing on maturity. Hence, you can see this is nothing but the graph here. What we are seeing is nothing but this particular thing. What you are seeing here is a curve. Okay, this curve is nothing but yield curve. Okay, so why this is yield curve? We are seeing as we are moving from 1 month to 3 month or 3 month to 6 months. As you see here, when we are in the first month, we get this much return, or we get this much yield, or this much is what the interest what we are getting. Okay, fine. And when we move from 1 month to 3 months, it increases. From 6, again it increases. It goes on increasing. You can see as the maturity period is going on increasing, the yield is also increasing, or it is sloping up, it's going upwards. That shows for a longer maturity bonds you expect or you get higher yields. Okay, as I have already explained you what is yield. Yield is nothing but the coupons what you get is nothing but the interest paid by the company which has borrowed from you, and that coupon again if you reinvest at some rate again you get interest on that, and all together this combine, and at the end when you when the maturity date comes, that day when you see, suppose you took a bond for $900 and the bond will give you $1,000 on maturity. So you would get $1,000 at any, you get $100 here. Okay, or let's say like you're getting company has promised you 10% coupon, it's for 5 years. Okay, so you see 10% is like 50, you'll be getting first year, second year you'll be getting 50, first year again 50, you invested at 10%, you get 5. First year you get 50 at the end, again 50 invested, 5 year you'll get again on 55, like that you'll be going on getting every year. And when you calculate all of them, add all of them, and also see you get coupons every year, 50 50 50 50 50 5 years, and in the at the end you get the money, that is $1,000 on maturity. Okay, and when I see this last year, it is like 50 plus 1,000 altogether, or 1,050. So we can write 50 plus 50 plus 50 plus 1050. You can write like this. So when we discount them at some rate, that rate is nothing but that rate at which we discount and get 900 is the present value. Okay, and the rate at which we discount get 900 is nothing but our required rate of return from the company. Correct. So now what happens, this 50 you get from company, again you reinvest it, you get $5, again 50, reinvest it $5, reinvest it at the rate of 10%, reinvest it. So when you reinvest all the times, you get extra money. And when we at the end calculate, we get more 5 for 5 years, 25 also we get. So 50 for first year, 50 for second year, third year, fourth year, fifth year. So 250 plus 25 plus 1,000. So like 2, like 7, 5. This much you are getting. Okay, and you invested how much? 900. So how much is the return? So 1275 by minus 1 into 100. So it's like somewhere around, just a second. If I can find out it in two ways, I can find. I invested 900, it's 1275 right now. So 1275 minus 900 by 900 into 100, or 1275 by 900 minus 1. If I do, I can get the answer. So I get 41.66% something you're getting. Understood, Zarina? Hello?
Yes, sir.
Did you understand what I said?
Yes.
Yeah. So you invested this much, you got this much, and the returns is this much. Okay. So that is nothing but your total yield from this. So you can see here, like 1 month, 3 months, as you see the 20th year, you get this much as your yield. Now it depends, like what I took 10% here, but the entire question itself is like the final yield they are giving is 6%. So mine was a higher coupon which I was giving. So the things are different. Okay, but like just a second. No, I'm not taking. I'm taking 5%. You would have corrected me. If I take 10%, it should be 100 here. Sorry, I'm taking 5%. Zena, did you get it? What I'm saying? Hello. Hello. Hello.
Your voice is, sir. Hello.
Are you able to? Are you able to hear?
Your voice is breaking in between.
Just a second. Just a second. Just a second. Can you hear me, Zarina, now?
Yeah, no, no, it's clear.
Yeah. So Zarina, I just took 10% by mistake. It is 5%. Okay.
Okay, yes, sir.
If it is 10%, then I should take coupon as 100, na?
Yes, sir.
Yeah. So I took 50. So my coupon, so I'm taking my interest as 5%. And I am reinvesting at the rate of 10%, let's say. At the rate of 10%. So I'm writing here coupon is equal to 5% and reinvestment rate. %. Okay. So I got coupon at 5%. So 1000 into 5% is equal to 50. And I am reinvesting at 10%. So 50 ka 10% is 5 rupees. I got every year. Okay. That's what. So now normally on any given date, longer term interest rates will be higher than short term interest rates. So as you go on, as you like increase the number of months, you see a higher yield every time. Okay. So the upward sloping curve expresses investors' requirement to receive more return for investing long term because their funds are tied up longer, which leads to more risk. That's why they want more returns. Okay. Just a second. Just a second. Now, downward sloping yield curve. So this is very simple. As you like see, you're going as the time period is increasing, your risk was increasing, so you are demanding higher returns. Okay, because of more risk, you are asking more returns, and that again reinvested was giving you even more. See, when I get 50, it's 50. When I reinvest that again, I get 5. So it increases, correct? So with time period and with again reinvesting more and more, my yield would increase more and more, correct? So this was the pattern we saw here, but let's see what about the downwards yield curve is. Now, so this is a very complicated one here. They are twisting with words, a lot of things they are twisting here, so you should try to understand what they are saying, then things would become easier. Okay. Now, it's a massive chapter, very big chapter. So let's see here what they are saying. I'll take a fresh page because I've already made it untidy, so that things can be understood very clearly. I'll read every point of this. Downward sloping curve. If the market expects interest rate to decrease in future, that means we are expecting the interest rates would decrease in future. That's we are discussing about long term. We are discussing about longer duration or longer period of time. See, again, duration is a different thing. Don't get confused with duration and maturity. Duration, I'm not speaking from the finance sense. Duration means my meaning of duration here is time period. Okay. If the maturity period is, let's say, if we see for a longer horizon or longer time, if the market expects interest rate to decrease in future, so we are expecting that in future, after down the line, after 5 years or so, the interest rates would decrease. Let's say borrowers will prefer to borrow short term. Okay. So if we expect that interest rates are going to decrease in the future, we would borrow for short term. Okay. Because why would we borrow for short term? If we take a long term loan right now, we kind of, what happen is we kind of like we are bound now to pay a higher interest rate, correct, Zarina? Because the interest rates are very high now. Long-term interest rates are very high. Are you
Hi.
following?
Yes. Yes, sir.
Right now, the long-term interest rates are very high. So now if we take a loan, we end up paying very high interest. So what we'll do is we wait for a ideal time after 3 or 4 or 5 years when the rates would decline. And then if we take a loan, long-term loan, that would be good or better. Janna, can you give me a second, please? Someone is like outside. I'm just coming in 2 minutes, okay?
Okay.
So now what happens is, if we know that in long term the rates are going to decline, we should wait for some time down the line, 4 or 5 years, and then borrow, because we get the loan at somewhat cheaper rate because the interest rates are going to decrease. We expect that. So right now, if we take at higher rate and we end up paying more interest. So it is better to borrow after 5 years. And now, since we have requirement of money, we borrow for short term. Okay. So borrower. So here the economics concept will come into picture. You can understand now. Borrowers will prefer to borrow short term, so they can refinance at lower interest rate later. Yeah. So what they can do is they can borrow short term, and then afterwards when their short term maturity, the loan is for short term maturity, and when like 5 years end up, you pay this, and then again you go for long term loan, so that you get loans at cheaper rates. Okay. Now, while investors prefer to invest long term, so this was about the borrowers. So borrowers take short term loan now. Okay, this is from borrower's perspective. Short term, like long term rates are high now. In future, long term rates will decrease. Okay, so they can refinance. Now let's see from the investor's perspective. Borrowers are the banks, investors are nothing but the guys who give loan to the banks, okay, to the borrowers. They buy the bonds. Now, while investors will prefer to invest long term, why they will invest? They will prefer to invest long term because they are getting higher rate now. Am I right? Investors are getting higher rate now, so they want to invest for long term because they want to enjoy
Yes, sir.
higher interest rates. So they can lock in current higher rate of return for a longer period of time. As a result, the supply of short-term funds will be low, while the demand for short-term funds will be high. Okay. So since the investors don't want to invest short-term, they want to invest long-term because they want higher rates, and they always look for higher rates, of course, and they're getting those higher rates right now because the long-term rates are high. So they do not want to invest in short-term. So short-term funds demand is high by the borrowers, short-term fund supply is less. Okay, now, so short-term funds will be low while demand will be high, so leading to an increase in short-term rates. So what will happen when the short-term funds demand is high, short-term rates will increase. So you can see the rates are high right now in the first month. Are you following this, Zarina? In the third, what happened in the first month? The rate is high, correct? Because the short-term funds
Yes, sir.
demand is very high, supply is less. So what happens slowly, steadily? As the time passes by, what happens? We go towards the long term, correct? So what happens? Short term supply is less, demand is high. Since demand is high, the rates are high. Okay, short term rates in the beginning. So at the same time, the supply of long term funds will be high while demand for long term funds will be low. So now that these borrowers don't want to take long term loans. Why? Because they expect the interest rates to go down in the future. So these guys show less demand, but the investors show more like interest towards supply of long term funds. Why? Because they want to invest in long term. So supply, so long term funds supply is high, long term funds demand is less. So I'll put all these things into picture. Short term, long term. Short term demand is high, supply is less. Long term supply is high, demand is less. So what would happen if the short term funds demand is high? The rates will be high. Okay, and when demand is high, the rates will be high. When supply is low, the rates will be high. Long term funds supply is more, so the rates would be down, and in long term demand would be less. Okay, right now the supply is high and demand is less. Please understand, right now I'm speaking about the current scenario. Short term funds demand is very high. That's the reason we see this is in the first month, the rate is very high since demand is high, and and the long term funds demand is very less right now. Okay, now, so at the same time, the supply of long term funds will be high while the demand for long term funds will be low, causing a decrease in long term rates. Okay, so since we see the long term demand is less, supply is high, we see the rates constantly going down. Okay, and here we are speaking about since we are seeing that long term funds supply is high, okay, and demand is less. So since supply is high, demand is less, the rates would be constantly sloping downwards. Okay, so this is about the downward sloping curve. Did you understand, Zarina?
Yes, sir.
You want any explanation once again in this? Did you understand?
Yes, I understand.
Yeah. So flat curve, if the market expects the interest rates will not change much in the future, you see a flat curve. That means demand and supply forces are at equilibrium there. Now, humped yield curve, as expectations change from increasing rates to decreasing rates. Yield curve may pass through a period in which it is humped or raised in middle. So what happens is, this is nothing but the trends are changing. As the demand is picking up for long-term funds, we see the curve going up. If the demand for long-term funds is going down, we see the curve going down. It's a combination of upward and downward curve. Okay, that's what. And here now yield curves for different types of bonds. You see there are different bonds here. One is treasury, one is AAA, one is BBB. This is the most risky one because of less ratings, somewhat less risky one because of somewhat higher ratings than B, but somewhat less ratings than US Treasury. But this is the most secured one in the world, the US Treasury, and you can see that since it's the most secured one, there is very less risk, so they'll give less returns, and the yield curve will start from here, but it will be upward sloping. Why? Because as we go down the line higher period of time, maturity period increases, we expect more returns because more yield, because our money is with the borrower for a long period of time. But the AAA corporate bond starts from here because of because of high risk, the curve starts from here, and still high risk, the curve starts from here. But all are showing the same kind of behavior. They're going upwards. So this was all about the yield curves, Zarina. What I'll do is, yield curve theories I won't explain today. I will explain this in some other session. Today I am moving forward with another topic. I'll tell you why I am not explaining yield curve today. We'll take a separate session for that. Now we'll come to the bond instrument. See, as you know very well, what is a bond? Bond is a security for an investor or a bond holder. So this is a bank, this is a customer. Customer wants loan from bank. Bank says you bring your property documents or land papers, and you have to give that as a collateral with us or mortgage with us, and we'll give you a loan. Okay. As you know, bank, why they want the property documents? Because they want a security from the borrower regarding that particular loan. That means bank doesn't want to take any kind of headache. If this guy doesn't repay, they can claim their money by selling the security because they have right of lien. Okay. Same way, let's take now the company. Company is the borrower, and these are the people. People even say, if you want to borrow from us, you borrow, no problem, but you give us a security. The security is here. The security here is nothing but the bond, and bond has a backup of company's assets. Okay. And since here also you have taken a loan, you pay interest to the bank. Till the time you don't repay the entire loan, the property is with the bank. Once you repay the entire loan on the maturity date, the documents are handed over to you. Same thing, company, till the company doesn't repay you, they'll pay interest. That's coupon. And when they pay back everything to you, they get their bond back, and you get your money back. Okay. Now bond index. So here you can see that bonds are always in the denomination of $1,000. Okay. And that is also called as the face value or par value. That means that is the borrowed amount by the bank from you, on which the bank will be paying you coupon. Okay. Or interest, agreed interest, or the interest what you and bank fix when you make the agreement. Now, next one, bond indenture. See, bond indenture is nothing but it's a document which contains all the details of a bond. So that means it has nothing but all the details, like who is the borrower, the company, and who is the lender, the people, and what company has. It shows the terms and conditions of the contract between the company, the borrower, and the investor. It shows how much coupon the company has agreed to pay, what is the maturity date, and everything. All the details of the contract between the investor, lender, and borrower is there in the bond indenture. Who are restrictive covenants? See, if company has taken a loan or has issued bonds and they have borrowed money, again, if they want money, again they want finance or funds for some other, for some reinvestment purpose or for some other reason, they want to, they have requirement of funds, again they want to put in the company for some operations. Let's say if they approach for loans to other institutions or banks, or again if they want to issue bonds to public, they cannot do that, because there are some clause which restrict them from taking additional loan until and unless they repay the old loan to the bondholder. So suppose I have given a loan to a loan of 10 lakhs to a company. I make an agreement with them that until unless you repay my loan, you are not going to take any loan from any other party. If it is like that, if it's not like that, then they can borrow the money from anyone. Okay, these are called covenants. Now, bond issue may include a sinking fund requirements. Nothing but company, what they do is they make a separate fund and they accumulate money in that to repay the money to the people. See, they pay, they make the payments in form, in nothing but in the form of EMI, easy monthly installment. You know, EMI is nothing but it's a combination of principal element plus interest. So what they do is they just deposit money in a fund and from that they make the payments. Okay. Now, if a bond is a mortgage bond secured by some property, so what happens? The covenants may include requirements such as issuer of the bond will maintain the property in good operating condition. Yeah, if the company has borrowed money from people and there are some conditions, prerequisites, like since the property is secured, is the one which has been pledged, which has been like pledged, and things are written in the bond that company is borrowing money, and if company does not pay, the investors have right of lien. That means they can claim their money by selling the property of the company. So the conditions in the contract would be clearly agreed between the company and the lenders, that company should maintain the property in a very good condition so that when they don't pay and the property is disposed of, the investors get a fair amount of money so that they are not in losses and they recover their money. Mortgage bonds covenants may also include negative pledge clause. Negative pledge clause is covenant stating that issuing corporation will not pledge. See, what once the assets have been pledged and the bonds have been issued to some 100 people, okay, again company cannot pledge this particular assets and issue other bonds to some other set of 100 people, because these people will restrict company from doing that because of negative pledge clause. Now, call provision. Call provision is nothing but company which is issuing the bonds to people also while issuing the bond, they have some options with them. That means those options are nothing but call provision. That means the company will issue the bonds to people and will also give an option to them, as per which company will buy back the bond at some fixed price in the future from the issuers, from the investors. Okay. So with that condition only company will issue the bond. So this is Tata company and it's issuing bonds to people, and the option what the bond carries is Tata company may buy back the bonds from the people after 5 years at some fixed price what they fix today and which is agreed by all the investors. So that's a call provision. It's very beneficial for Tata company in my example. Okay. Now, because they can like retire their loan early by paying back the money. Now, next one. Next one. Bonds may also be puttable. See, callable or call option is nothing but option to buy. And put option is option to sell. So the previous case, I gave an example that company can buy back the bonds, okay, at a predetermined or agreed price, okay, while issuing the bonds. But this puttable is nothing but option to sell. So bonds may also be puttable. Puttable is similar to callable, except that the option to retire the bond belongs to purchaser of the bond. That means if certain events occur or if the issuing company violates any bond covenants, an investor can require that the issuer repurchase the bonds from him. The price the issuer must pay to repurchase the bonds will either be specifically established or can be calculated in accordance with the terms of the indenture. So what happens is, this is the, I'll explain the differences between callable and puttable. Callable, puttable. So here the company, while issuing the bonds, also has option to buy back the bonds from the investors at an agreed price. Putable bonds, this is nothing but the option which the investors have to sell the bond to company in the event of company not making their coupon payments timely or not repaying them back, or any kind of event happens whereby they think that their money is in danger. So they immediately can, because they have the option, they can ask the company to buy back the bonds from them at some price which they fix or as per the indenture already fixed. Okay, that's what. So here you can see that this is a bond. It has a par value of 1000. This is a coupon rate, and this has been issued on this date. Maturity is on this. It's a 10-year one, and the coupon is paid semi-annually, and that happens every 6 months. So you have an idea about all those things. Okay. Now what we can do is we can see a question and we can calculate the price of a bond. Okay. Bond codes. Let's see. Here is a question, Zarina. Payton Corporation issued $900, $1,000, 1,000 bonds actually, $1,000 bonds. So 900, not dollar. 900 is the number of bonds into per bond of $1,000 will make this much value. This much company is borrowing. So this is the face or par value of the issue. Okay. And term is 10 years, interest rate is this. That means this is the agreed interest rate by the company. What company is ready to pay as coupon? They pay coupon semi-annually. This is the market rate which is prevailing right now in the market. This is the issuance cost what they have faced. Okay. So you know bonds are issued and they are not issued at free of cost. You know they really are issued like by the company, and companies incur some cost for that. Like they have to hire an attorney or lawyer who could do all the formal documentation of all these things, registration and all. You know there are a lot of things are involved in the back end. The cash outflows for each $100,000 bond are as follows. Semi-annual. See, you know, like the interest are paid semi-annually. So this is the coupon rate. I would say this as coupon rate. The agreed rate is also called as coupon rate. So semi-annual interest payment would be this much, that is $1,000 per bond into the coupon rate by 2. Why by 2? Because it's a semi-annual interest payment. When it is semi-annual, you have to make the rate as half. Okay, because now 6 months period is one period and 1 year period is 2 periods here. Now repayment of principal $1,000 on maturity date. Yes. Okay, so they are calculating per bond wise. So this is the one. See, company has borrowed $1,000 from people. See, company has issued 900 bonds. One bond is of $1,000. Company has borrowed in totality 9 lakhs, but you know, per bond is of $1,000. That means company has borrowed $1,000 per bond, and they have to repay that $1,000. Okay. Now let's understand what is happening here, and you should be knowing one fact. Whenever, see, the question is very clear. They're asking something to find out the present value. Maybe that's what they're asking. Now they're doing that. See, the issue price for $1,000 bond is, see, company has borrowed $1,000 from people, and the interest what they are paying is 5.664%. And in market, the coupon rate, the interest rate, this is the coupon rate, and 6% is the market interest rate. You know one thing, when market interest rate is high and company is paying less, this bond is what bond? It's a discount or premium bond?
Discount. Yes.
Discount bond. If the market interest rate is very clearly given 6% and company is paying this much, so your company is paying less and the market interest rate is more. So when you want to sell your bond, you cannot sell at higher price, you'll sell at lower price only. It's a discount bond. It's a discount bond. So let's say the bond is having some value which we are supposed to find, and this is the value of the bond on the date of maturity. That means this is the face value of the bond. Okay, so company will borrow this much only, but the bond can trade at some other price in the market. Now what is the price at which the bond is trading? We'll right now find out. Since we understood that it's a discount bond, If suppose the market interest rate would have been 4%, it would have been a premium bond. That means the bond would have been sold at more than $1,000. So now it's $1,000 his company borrowed. The bond is selling at discount, so it will be somewhere around some 900 plus something, some value. If it's a premium bond, it would have been 1,050 something. Okay, example, I'm giving an example. And this discount and premium can only happen if the market interest rate is 6% and coupon is 6%, the bond will be sold at par. If the market interest rate is 6% and coupon is, see, market interest rate is 6%, not 6%, let's say. Company is paying a coupon of 7% and market interest rate is 6%. So this bond will be sold at what? Premium. It's a premium bond. And if the market interest rate is 6% and the bond coupon is 4%, it's a discount bond because company is paying less. So what we'll do is, we know like there are, it's for 10 years, correct? It's for 10 years. The maturity is for 10 years. It's a semi-annual coupon bond. So the coupon are paid semi-annually. So we'll take 20 periods. Okay, we'll take, see what we're doing. We are kind of making the rate half because it's a semi-annual payment. And we are making in the time period double. That's a rule. Always understand. This is the coupon payment, and you should know one thing. We always discount the coupon at market interest rate. That's the rule because that's the rate what we want. So when we found out the present value of annuity factor of 20 periods for 3%, that's this. We got this value. And $1,000 after 20 periods, what we are going to get, the present value of that today is this. That is, you're taking 3% as discount factor and you're finding out the factor for 20 periods. It's this. When you combine these two, you get the bond present value, that's 975. It's a bond which is sold at 975 right now and redeemed $1,000 on maturity. So bond is selling at discount and it will be redeemed at par. Okay. So that's what it is. So 975 I can take, and 900 bonds into 975 will give me the total bond value. So this is the bond value, but I'll deduct the issuance cost. So total net cash flow is this much for me from the bond issue. That means this much I will be getting, that I can utilize in my business, okay, for some purpose. So Zarina, we will just finish till here, and on Monday we will start from types of bonds. Okay. Hello.
Oh, yes, sir.
Okay, sir. Now Monday we will sit. We'll take the class at the same time, or if I'm ready early, I'll call and inform the time so that we can finish some 10 pages on Monday. Okay. Or if I find time tomorrow, any case, I'll inform you if I can take tomorrow also. Fine.
Okay. Okay.
Okay, Zarina. Thank you. Thank you.